And it was a volatile week in the Indian equity markets as bulls and bears battled for control. Investors saw sharp swings in both sentiment and prices. Momentum remained positive for much of the week, but the mood shifted sharply on Thursday. The Sensex plunged more than 1,200 points in a single session. Over 3 lakh crore rupees in market capitalization was wiped out in the last hour of trade. Rising U.S.-Iran tensions drove Brent crude above $70 per barrel in the week. Higher oil prices reignited inflation worries in India. The Nifty also faced technical resistance near the 26,000 level. Heavy profit booking ahead of the F&O expiry added to the pressure. The last day of the trading week brought partial relief. Markets recovered modestly as investors engaged in selective buying. The Nifty stabilized around 25,570 by the close. Well, despite the turbulence, domestic fundamentals remain steady. India's GDP growth is estimated at 6 to 7%. However, global developments continue to influence sentiment. Oil price movements and geopolitical tensions remain key risks. The week highlighted the fragile balance between optimism and caution. Sharp rallies and sudden declines kept investors alert. Now, the overall message was clear. Markets remain resilient, but volatility is far from over. And to discuss more, we're now being joined by Subhash Chandra Garg, former Finance Secretary of India, and he's joining us live from New Delhi. Thank you so much for joining us on the broadcast. Firstly, let's address this elephant in the room now. How do you assess the immediate and medium-term market impact of this Accord versus Trump showdown over the tariffs?
See, I think this is this will need to be handled very well. What has been done is 18% is now replaced by 10%. And Trump would most likely come up with other solutions. This is also temporary. 10% is also temporary for next 4 or 5 months. And therefore, it's very important for India to sort of conclude this deal now from a positional strength. This has been demonstrated very well that the agriculture, which India used to think that was its no-go area because it wanted to protect so-called farmers' interests, was actually not really affecting farmers. Post the deal, you've seen very little reaction from the farmers group and all. And so this gives a ground for India to sort of negotiate from the positional strength and get 0% tariff, additional tariff from US by offering open market access to American agriculture products. They wouldn't come in any case too much because of the cost differential, the distance and other things. So if you can negotiate that, I think that would be very positive for Indian markets and India as such.
Right. And just to clarify this out, what we know was that the tariff was reduced to 18%. Are we clear about the fact that now it's reduced to 10%, or is this additional apart from the 18% we had before? Because even though we've been talking to experts and they say that, Trump has dynamic ways of handling such a crisis. He knows how to use other laws to still get away with this, the tariff. So just to be clear, what is this, 10% or 18?
18 is gone. There is no doubt about it.
Okay.
It's replaced by 10% for the time being. He can come up with other solutions for those countries which don't sort of do the deal with them.
Yeah.
There are many levers you can do that. And even if you do it illegally, like he did last time for the reciprocal tariffs, it takes months to get them vacated in the courts and all. So for the time being, 18% is gone.
Okay.
25% in India's case, it was not 18%. It was 25%. So 25% is gone. It's replaced by 10%. Something might come up unless we do a deal. And that's why I was saying that we should do the deal from the positional strength.
All right, now let's reflect this on the markets. Do you expect crude oil prices to remain a major risk for Indian markets as of now?
See, oil is not a major risk for the markets in India any longer because the way it has been done, the consumer prices have been kept fixed for last many months. It doesn't affect the buyers in industry, it doesn't affect the consumers. So the price, whatever it is in the international trade, For the domestic market is a non-issue. What it affects is basically the companies within the oil business, ONGCs, OMCs, and some of the companies like Reliance and others. If the oil prices go beyond, to my mind, about up to $80 dollars per barrel, there is not much risk to them either. But if it goes beyond, they may have the OMCs will suffer, but the ONGC will gain, Reliance will have something. But taking for the market as a whole, broader market,
Right.
I don't think this makes much difference to India.
And talking of Reliance, so let's come to tech now. How do you see Indian tech stocks performing in the current global environment?
That's the real risk, because Indian tech, which is IT based, humans using the digital technologies to provide world class services, we got a very massive exports in the IT services. That's at a risk because of better tooling available from the AI now. The trick would be that if Indian companies can also master the developing AI and use its own resources to use the AI for providing better and more efficient services, I think Indian IT industry will do well. But if it does not, it can't invent the LLMs and create knowledge or the tools of AI, but it can use the AI tools for delivering better services. If that they can figure out, I think they'll do well. If they don't, what you saw, a 15 to 17% meltdown of the IT stocks in India might see further meltdown in time to come.
All right. Well, thank you so much for coming on the broadcast and giving us a download of everything that's been happening. Pleasure speaking to you.
Thank you.